Good afternoon, everybody. Today, in this accounting for manager as a subject, the fifth session, it is for cash flow reporting. Cash flow, it is a financial statement analysis. It is a part of financial statement analysis. And in the year 1995, when the SEBI, Security Exchange Board of India, made it mandatory for listing companies to enclose the cash flow statement in the annual report, along with the profit and loss account and the balance sheet. That means the income statement and position statement should also be attached with the cash flow statement. And that became mandatory since 1995 due to regulations of the SEBI. Prior to that, along with cash flow statement, funds flow statement was rampantly in use. In case of funds flow statement, they used to take into consideration the funds, which includes other current assets, which are beyond the cash and cash equivalent. Fund means it was taking the current assets like cash, bank balance, inventory, sundry debtors, accrued interest, and other short-term advances, etc. They were all forming part of the current assets. And fund was current assets minus current liabilities. Current liability means either sundry creditor, bank overdraft, outstanding expenses, bills payable, all these things. Current assets minus current liability is the fund, and that was otherwise called the net working capital. Excess of current assets over current liabilities, free current assets, or net working capital. And in this funds flow statement, there are first, when we are talking about the fund means the net current asset or free current assets or whatever we have discussed earlier. And this fund, when there is any change in the fund's position, it was called the flow of fund. That means change can be a positive change or change can be a negative change. That means if due to any particular transaction, there is an increase in the fund's position of the organization during a certain period, then that transaction is called to be a positive flow of funds, which is otherwise called the sources of funds. Likewise, there may be a negative flow of fund also. When there is a negative flow of funds, that means it is a decrease in the funds position. That means due to any transaction during a particular period, the position of the funds goes down. That means the earlier position is being reduced to a certain extent. When that took place, it is called application of funds or usage of funds. And when we are preparing funds flow statement, and we are also preparing the cash flow statement, then there are 4 steps involved in the funds preparation of the funds flow statement. The first one is statement of changes in working capital. Then preparation of the individual accounts involving hidden transaction. Then the third one was preparation of adjusted profit and loss account or the memorandum profit and loss account. And finally, the funds flow statement was being prepared. When we are preparing the statement of changes in working capital, we took into consideration the changes in all assets and liabilities in two different balance sheet dates. The two consecutive balance sheets were being taken into consideration. They were put in the format, and the changes in the figures of assets of individual assets and liabilities were being incorporated in the statement of changes in working capital to find out either the net increase in working capital or net decrease in working capital. Net decrease in working capital or net increase in working capital were being dealt with in the funds flow statement, either as sources or application. The next step was in the funds flow statement, that was about statement of preparation of individual accounts involving hidden transactions, because there were certain items which are available in the funds flow statement. It is available in the balance sheet, but its position is not clearly reflected. That's why it is being called as hidden transaction. When there is hidden transaction, that has to be taken care of by preparation of the individual accounts. Take the example of a depreciation. Suppose the balance sheet shows that at the beginning of at the opening day of the balance sheet, the furniture and fixture was say 50,000, and at the end of the year, the furniture and the position of the furniture and fixture is say 45,000. That means there is a reduction in the amount of furniture, and that amount of furniture of rupees 5,000 is it has to be treated as depreciation. It can be treated as depreciation. It can also be treated as a reduction in the value of furniture due to sale of furniture. So when the additional information is given after the balance sheet, the additional information is given that the furniture and fixture, the depreciation is written up on furniture and fixture to the extent of 5,000, then that has to be taken into consideration while preparing the furniture and fixtures account, and it will not result into any sale of furniture. So all these things have to be taken care of in the second step of funds flow statement, which is called the preparation of individual accounts involving hidden transaction. And the next step is memorandum profit and loss account or the adjusted profit and loss account. The role behind preparation of memorandum PL account or the adjusted profit and loss account also exists in case of preparation of the cash flow statement. What happens in what is the role of that memorandum PL account in preparation of the cash flow statement or funds flow statement? Actually, what happens in case of funds flow statement, when we are determining the net profit of the organization as the net flow of funds, of the net funds from operation, because the incomes, if you take into consideration the profit and loss account for a particular period, then that all the incomes, that means all the items appearing in the credit side of the profit and loss account are incomes, and those incomes are positive flow of funds or sources of funds, and all the items appearing in the debit side of the profit and loss account are negative flow of funds or usage of funds or application of funds. So instead of taking the individual items of income as sources of funds and individual items of expenses as applications of fund, we can take, if there is net profit, we can take the net profit as the funds from operation or the net source from flow of funds. When that is being taken, the net profit is being taken as the flow, the sources of funds or the positive flow of funds, that can be interpreted as funds from operation. That means the operating flow of funds. But there are certain items which are included in the profit and loss account, the debit side, which do not result into application of funds. Actually, what happens, all the expenses are application of funds, but there are certain items appearing in the debit side of the profit and loss account as expense, but they do not result into funds. The item is like depreciation. Depreciation doesn't result into application of funds because there is no flow of funds when the depreciation is written off from the any of the fixed assets of the organization during a certain period. So when items like depreciation are being included in the income statement of the profit and loss account, in that case, the net profit cannot be regarded as the funds from operation. In that juncture, the net profit is subject to certain adjustment for determination of the funds from operation. That means the amount of depreciation ought to be added with the net profit in order to find out that what is the actual funds from operation. So in order to do that in a scientific manner, we need to prepare the memorandum profit and loss account or the adjusted profit and loss account, where the opening balance and closing balance of the profit and loss account is taken in the, if there is profit, then it has to be taken in the credit side of the memorandum PL account. If there is loss, it has to be taken in the debit side of the memorandum PL account. And and all other adjustments like depreciation, writing of will, provision for income tax, proposed dividend, all these items which are treated as expenses but do not result into application of funds. Similarly, there are items of income which do not result into sources of funds. All these items are supposed to be taken into consideration in the memorandum profit and loss account, and then the balancing of the profit and the memorandum profit and loss account ought to be done. And the balancing figure, if it comes in the credit side of the memorandum profit and loss account, that would be funds from operation, and if it appears in the debit side of the memorandum PL account, it would be fund lost in the operation, FLO and FFO. So after preparation of this, after finding out this, what is that, funds from operation or funds lost in operation, the last step would be preparation of the funds flow statement. And when funds flow statement is prepared and cash flow statement is prepared simultaneously, then there was one equation to convert the funds from operation to cash from operation, and that has to be taken into consideration for preparation of the cash flow and nothing else. So the equation was funds from operation plus decrease in current assets plus increase in current liability plus increase in current assets minus decrease in current assets and minus increase in current liabilities. With that equation, we can convert the funds from operation to cash from operation. When we prepare the cash flow statement, since 1995, when the SEBI has made it mandatory, the attachment of the cash flow statement to the annual report of the organization, then the utility of the funds flow statement became jeopardized, and no emphasis was given on preparation of the funds flow statement. Only the emphasis was given on the cash flow statement. And moreover, when the accounting standard AS3 is designed, that also started giving emphasis on the cash flow statement. And from that, the importance of cash flow statement became manifold. Cash means what? The difference between funds and cash. Funds means it includes all current assets and current liabilities, whereas the cash means it is cash in hand and demand deposits with banks. That means if we are having any current account in any bank account or any savings account, even whatever balance you are maintaining in that bank account, that will form cash. And it plays a very important role in the entire economic life of the business house. And it is just like, the cash is just like a blood in the human body. Cash flow statement includes cash as well as the cash equivalent. Not only the hard cash or the cash and bank balance, it also includes the cash equivalent. Cash equivalent means it includes short-term and highly liquid investments which are readily convertible into known amount of cash without incurring any loss therefrom. That means when the organization is having some highly liquid securities in its hand, which can be sold in the market immediately or instantly when it is required, without any loss thereof, without incurring any loss thereof, that would be treated as that would be treated as what? That would be treated as cash equivalent. So cash and cash equivalent both are taken into consideration for cash flow statement. Flow of cash means what? Flow of cash means just like funds flow statement, flow of funds. So exactly in the similar manner, flow of cash means any change in the cash position. Change may be a positive change may be a negative change. When there is any increase in the cash or cash equivalent due to the effect of any particular transaction, then we can say it is positive flow of cash, and positive flow of cash is otherwise called the inflow of cash. Similarly, there may be a negative flow of cash. Negative flow of cash means when there is any payment, it reduces the cash position of the organization. Cash or cash equivalent get down. When any transaction resulted into negative flow of cash, that is called usage of cash or application of cash or outflow of cash. So when this is cash and flow of cash, then what is cash flow statement? Cash flow statement is a statement which describes the inflows or sources and outflows or uses of cash and cash equivalent during a specific period of time. It excludes movement between items that constitutes cash and cash equivalent because those items are part of the cash management. That means when transaction takes place between cash management means what? This includes the investment of excess cash in cash equivalent. That means when there is need in the hands of the organization, there may be transfer of cash into cash equivalent, or there may be transfer of cash equivalent into cash. These are called the internal transactions between cash and cash equivalent, which is otherwise called the cash management. So cash management, the transactions effected or undertaken under cash management system, they are not specifically reported in a cash flow statement. So uses of cash means it may be payment to suppliers, it may be day-to-day expenses of the organization, it may be payment of salary, wages, payment of interest, payment of dividend, etc., etc. So these are called the basics of cash flow statement. When we will proceed further, we can prepare cash flow statement from the profitability statement, otherwise called the income statement, or we can prepare the cash flow statement from the balance sheet or the position statement. Now the thing is, in the introduction stage, when we talk about the cash flow reporting or cash flow statement, we can find out or we can see that why cash flow statement. Look to the slide. What is cash? What is cash? We have already discussed. What is cash flow reporting? Cash flow reporting means during a particular period, what is the inflow of cash or what are the sources from which the cash gets into the organization, and in what way such cash or that generation of cash is getting utilized. For that purpose, we need to take the two balance sheet figures, that the balance sheet figures of two consecutive dates, and basing on those data, we used to prepare the cash flow statement. Is there a difference between book profit and cash profit? Obviously, there is a difference between book profit and cash profit. Book profit means the profit exhibited in the income statement or the profit and loss account. The net profit can be called as the book profit of the organization. But what happens if all the transactions during the particular period of that particular organization are all made through cash, then it won't make any difference between the book profit and cash profit. That means if all the sales are done in cash, if all the purchases are done in cash, if all the expenses are paid in cash, all other incomes are received in cash, then whatever profit will be generated out of that, then that would be the book profit, and that would also be the cash profit in the hands of the organization. But that doesn't, in practice, that doesn't happen. So what happens when we are effecting sales? Sales means what? Any inflow of cash or cash equivalent resulting out of sale of goods, rendering of services, or utilization of any resources of the organization, but excluding the receipts on behalf of third parties. So when sales are effected, if the sale is a cash sale, then the entire sale proceeds will come to the organization, and that will be incorporated in the credit side of the profit and loss account. But if a part of the sale is credit sale, that means sale is effected, but it gives rise to debtors because the money has to be collected in a subsequent date. When that takes place and that collection stretches beyond the financial year, then what will happen? To that extent, there will be shortfall of cash between the book profit and in the cash profit. So the same thing may also happen in case of expenses. When all expenses are made in cash, and in that case, the book profit will be equivalent to that of the cash profit. Suppose we have effected purchases of rupees 1 lakh. Out of that, 10,000 is a credit purchase. That means we have not paid the amount to the person from whom we have effected purchases. It gives rise to sundry creditor. So when there is sundry creditor, that means there is an amount of credit purchase. That means to that extent, surplus cash will be available in the hands of the organization beyond the book profit. So these are the reasons. So also the case of expenses. If a part of expenses is outstanding, suppose the total salary is 1,20,000, out of outstanding salary is 20,000. In that case, when 20,000 is the outstanding salary, that means salary payable. To that extent, the salary has not been paid to the employees, and this much of salary must be there in the hands of the organization. So to that extent, there would be a difference between the book profit as well as the cash profit. The cash profit would have been more than that of the book profit. Then the next is, what is liquidity? The liquidity means the easy convertibility into cash. The availability of cash or cash equivalent is called the liquidity. Is it possible that a company may have huge profit, but still it suffers from liquidity problem? Yes, it is quite common. How? Suppose the net profit of an organization, net profit of a company, say, is 10 lakhs. But this company at the end of the year, during which it has earned a profit of rupees 10 lakhs, it has given rise to a sundry debtor to the extent of 5 lakhs. That means at the beginning of the year, there was no sundry debtor, but at the end of the period for which the company has earned a profit of rupees 10 lakhs. So on that particular day, that means as on the close of the year, the sundry debtor is there amounting to rupees 5 lakhs, which was zero at the beginning of the year. What does it mean? It gives rise to sundry debtor of 5 lakhs means to that extent there is shortfall of cash in the hands of the company. This much of amount is not being realized from its customers as against the sales effected by the company. So even if the profit is there to the extent of 10 lakhs, the net profit is 10 lakhs or the book profit is 10 lakhs as reflected in the income statement of the profit and loss account, there won't be cash to that extent in the hands of the organization. The cash must be less than 5 lakhs because that 5 lakhs is remaining with the sundry debtors to be realized in a subsequent period. Similarly, if there is huge capital expenditure, suppose the book profit or the net profit of any organization is 10 lakhs, out of which 5 lakhs is the sundry debtors. That means the cash profit or the availability of cash will be reduced by 5 lakhs, and the cash of 5 lakhs will be there only in the hands of the organization at the end of the year. Again, in this situation, suppose there is a capital investment. Capital investment means block capital investment. Block capital investment means the organization has incurred some expansion program, and on that expansion program it has spent 3 lakhs rupees initially. When 3 lakhs rupees is spent on expansion program, that is a capital item. It's a capital item means it will not affect the profitability of the concern. It will not find its place in the profit and loss account. That means it will not going to affect the net profit position in any way. But to that extent, the cash has been wiped out because of the investment in the expansion program. So although the net profit is 5 lakhs after adjustment of the cash profit is 5 lakhs after adjustment of what is that sundry debtor, again it will be reduced by 3 lakhs because that amount of cash got invested in expansion program. So cash to the extent of 2 lakhs only is available in the hands of the organization. So obviously there is a difference. There ought to have any difference between the profit and the liquidity position. Again, cash is the nerve center around which business activities flows. So it is quite common because cash is said to be the blood of a human being. The profit figure shown in the profit and loss statement is the book profit. It doesn't represent cash profit. Obviously, it is true, as explained earlier. When there is profit and all the transactions in the profit and loss account, all the items are cash items, all the expenses are paid in cash, and all the incomes are received in cash, then obviously the net profit would be equal to the cash profit. The book profit would be equal to the cash profit, but in practice it doesn't happen so because of the reasons as explained earlier. A firm may show book profit but may still face liquidity problems. Yes, that's true as explained earlier. Suppose the net profit of or the book profit of an organization is 5 lakhs and it has spent a majority of amount in an expansion program as explained earlier. In that case, what will happen? There will be impairment of cash position in the hands of the organization, as a result of which it will face the liquidity problem. If suppose there is a target given to the sales manager of a company to increase the sales, to meet the target, the sales is expanded like anything, but at the same time, it gives rise to the sundry debtors. That means most of the sales were credit sales. The entire sale, both cash and credit sale, will be taken into the revenue. It will be reflected in the credit side of the profit and loss account. So when there is more sale, the profit would be more. When the volume of sale is more, the profit would be more if the margin is there. But if most of these sales are not cash sales, that means a major part of the sales is credit sales. That means and the credit term is quite lengthier, then what will happen? The amount will be remaining with the sundry debtors, and its realization will take a time. There must be a time lag between realization, and that time, during that period of effecting sales and realization from the sundry debtors, obviously there will be a liquidity crunch in the hands of the organization. There is no way out. So care must be taken while giving target to the salespeople that the realization must be taken care of simultaneously. Otherwise, the company must be showing the profit, but at the same time, the liquidity position is very tight and there may be a loss of liquidity. And it may show up, in long run also, it may give rise to the bad debts. That means, bad debts means the debt which is not recoverable or which is not realizable from the sundry debtors. So if that be the case, then obviously the liquidity problem will be faced by the organization. Next, it shows how a company is generated, cash flow statement. What is the utility of the cash flow statement? Cash flow statement shows how a company is generating cash from its operations from paying for its growth, managing various sources of funds. Cash flow statement, as per the accounting standard 3, has been segregated into 3 components. One is operating flow of cash, second one is investing flow of cash, and the third one is financing flow of cash. Operating flow of cash means the cash generated from principal operating activity of the organization. That means principal revenue producing activities. That is the operating activity, you can say. That means when an organization, suppose a trader of, say, ready-made goods, in the hands of a trader of a ready-made goods, the principal revenue earning activity is the sale proceeds. Sale proceeds can be said as the principal revenue producing activity. When there is principal revenue producing activities, is sale proceeds in the hands of the trader. There may be other incomes at the same time. The other incomes means if there is any sale of waste products. Waste products means the packing materials, etc., etc. That cannot be regarded as the principal revenue or the principal activity from which the revenue is being generated. The principal revenue activity, revenue producing activity is the sale proceeds in the hands of the trader. When that takes place, we can take that into consideration as the operating activities, and the gross revenue cannot be the gross revenue resulted into the inflow of cash. But from that inflow of cash, there would be outflow of cash like purchases, like direct expenses, like indirect expenses, which are being paid, repayment of loan, etc., etc. After taking all these things into consideration, the cash will be there in the hands of the organization. For determination of the operating flow of cash, there are 2 ways in the hands of the organization. While preparing the cash flow statement, there are 2 methods for determining the operating flow of cash. One is the direct method and the other one is the indirect method. In case of direct method, what happens? You can say operating activities. Operating activities, examples of cash inflows in case of operating activities, it is proceeds from the sale of goods and rendering of services, receipts from the royalties, fees and commissions, cash receipts relating to futures, forwards, options and swap contracts, etc. The contracts are held for trading purposes. These are the operating activities which are resulted into inflow of cash. Similarly, there may be operating activities which resulted into outflow of cash, and they are payments to suppliers for goods and services, cash payment to and on behalf of the employees, cash payment of income tax other than distribution tax. All these are the outflow of cash from operating activities. When the inflow from operating activities is more than the outflow of cash from the operating activities, then there will be net positive flow of cash from operating activities. While preparing the operating cash flow from operating activities in a direct method, we can take all the revenues, all the items of revenues into account, and we can take all the items of expenses into account instead of taking the net profit or the net result of the profit and loss account as the basis for preparation of the cash flow statement. All the individual items of incomes, all the individual items of expenses are taken into consideration, and that is called the direct method for preparation of the cash flow statement under operating activities. And in case of indirect method of operating determination of the operating flow of cash, what we do? We took the net result of the funds, net result of the profit and loss account of the income statement. That means the profit or net profit. If there is net profit, the net profit is taken into consideration. and some adjustments are effected there too. And the adjustments are if there is an increase in debtors, then that must have reduced the cash profit from that of the net profit or the book profit. So that has to be taken into consideration, or that has to be added with the net profit to find out the operating flow of cash. Similarly, if there is an increase in current liabilities, if there is an increase in current liability, means to that extent the cash are available, the excess cash is available in the hands of the organization. That means it will give rise to the cash position in the hands of the organization. That means it will be added to the net profit for determination of the cash position of the organization. So accordingly, that is called the indirect method of preparation of the cash flow statement. This direct method and indirect method is applicable only in case of operating activities. It has no role to play in case of other two activities like investing activities and financing activities. When we talk about investing activities of the cash flow, the examples of cash flow under that investing activities are cash received from disposal of fixed assets and investments other than cash equivalents. Cash received from disposal of fixed assets. Fixed assets means your block assets, you can say, and investment means the long-term investments. The short-term investments are not treated, it will come under the cash equivalent. Second item is interest and dividends which are being received on debentures and the shares which is being purchased or which are being held by the company. Then the third item of investing inflow is cash receipts from repayment of advances and loans made to third parties. That means when an organization has given, suppose some staff advances have been given. When staff advances have been given in a particular year and that has been realized in a subsequent year, when it is realized, that gives rise to the inflow of cash, and that comes under the inflow of cash under investing activities. And examples of cash outflows under investing activities are cash payments to acquire fixed assets, shares, and other securities. Other than cash equivalent means the short-term securities or highly liquid securities are not included therein. Other than the highly liquid securities and short-term securities, whatever payments are made for acquiring of the shares and bonds, and whatever payments are made for fixed assets may be tangible or intangible. All these things will come under the outflow of cash in the hands of the organization. Then the second outflow of cash would be cash advance and loans given to third parties. It is just opposite of the third item of the inflow of cash. When advances are given, that resulted into outflow of cash. Suppose there is staff advance, that will resulted into outflow of cash. When realization of staff advance is there, that will resulted into inflow of cash. So all these items are coming under investing activities of the organization. Then financing activities. Financing activities means, if we look to the financing activities, it speaks about activities that results in change in the size and composition of the owner's capital and borrowing of the entrepreneurs. Financing activities, that means how to raise the finance of the organization. It may come from issue of shares, it may become of issue of bonds and debentures, etc., etc. So the items, if we look to the individual items coming under that category, financing activities, the inflow comes from cash proceeds from issue of shares and debentures, etc. That means when we issue shares and debentures, that means when a company, shares means what? Shares means the capital of the company is segregated into or divided into a number of units, a number of identical units, and each unit is called a share. Debenture means the bonds are otherwise called the debentures. That means any document signifying the acknowledgement of debt of a company, any document signifying the acknowledgement of debt of a company payable, refundable after a certain period, bearing a fixed rate of interest, payable on periodic basis during the pendency of such debt. That means whenever there is any loan or any borrowed capital, it must be refundable in nature. And whenever any loan is there, it must bear an amount of interest payable therein. And there must, when interest is payable, a periodicity must be there. In case of debentures or bonds, the interest may be paid either on yearly basis or on half yearly basis. And accordingly, the warrants are issued to the persons who are holding the bonds or debentures. So that is the first item under the inflow of cash under financing activities. Second, when the issue of shares and debentures is not sufficient, then the company can approach the banks and financial institutions for taking loans. That would be the second item under the financing activities, long-term borrowings from banks and financial institutions. It may be a term loan. Term loan means the long-term loans which exist for a longer period of time, which can be invested in the block capital of the company. That can be the second item under the financing activities. And the outflows of cash under financing activities are repayment of loan. Repayment of loan means when the loan are repaid or refunded to the banks or financial institutions, and the loans must be certainly a long-term loan. Then repurchase of shares. Repurchase of shares means the buyback of shares by the company. Third one is interest paid. If there is an interest paid on the bonds, when you are issuing bonds, the inflow of cash is there. When the bond is there, when you are issuing bonds, then you are supposed to pay the periodic interest thereon. When the interest is paid thereon, it would be coming under the outflow of financing activities. Bond bears interest and shares bears dividend. Dividend has to be paid to the shareholders as a return on equity. When dividend is paid, that also resulted into outflow of cash, and that outflow of cash is coming under the financing activities. Outflow. The last item is the dividend tax paid, dividend distribution tax. The dividend distribution tax, when it is paid, 115 JP. When dividend distribution tax is paid, 115O. When dividend distribution tax is paid, 115O under the Income Tax Act. When dividend distribution tax is being paid, that will also result into outflow of cash under financing activities. So all these things are to be taken into consideration while preparing the cash flow statement. Differentiate the following cash flows as from the operating, investing, and finance activities. This is the task given to you. You can determine interest paid or received, what it is. Collection received from debtors, what it is. It is interest paid is definitely an outflow of cash. Collection received from debtors, it is obviously an inflow of cash. Payment of administrative expenses, it resulted into outflow of cash. Purchase of land and building, outflow of cash. Repayment of loans, outflow of cash. Payment of dividend, outflow of cash. Sell proceeds of investment, outflow of cash. Inflow of cash. Proceeds from issue of shares, inflow of cash. Long-term loans raised, inflow of cash. Payment made to suppliers, it is outflow of cash. But you need to segregate them depending upon which item comes under the operating activities, which items are coming under the investing activities, which items are coming under the financing activities. Under financing activities, your item of raising of long-term loans, proceeds from issue of shares, all these items will be coming under financing activities. And under investing activities, your purchase of land and building will be coming. And payment made to supplier will come under the operating activities. Interest paid and received, if the interest relates to any bonds and debentures held by the company, then it will come under the financing activities. Otherwise, it will come under the investing activities. collection received from debtors, obviously it comes under the operating activities. So accordingly, you need to segregate depending upon the nature and character of the items. What would be the cash from operation? What would be the cash from investment? What would be the cash from financing activities? This is the statement which speaks about the details about the preparation of cash flow statement from different activities. First one is profit before tax, which is otherwise called the PBT. Then adjustment as regards non-operating and non-cash items considered in profit before tax. That has to be taken into consideration. Either it is to be adjusted in a positive manner or it has to be adjusted in a negative manner. Then operating profit before working capital, before changes in working capital. That means 1 plus 2 would be the operating profit. First item and the second item, when it got adjusted, that would give rise to the operating profit. Then changes in the working capital, other than the cash and bank balance. The changes in the working capital, what I was talking about, you need to apply the equation. The equation is the funds from the net profit has to undergo the equation. The equation is in order to find out the cash from operation, the net increase in working capital has to be deducted. The net decrease in net decrease in working capital. The net increase in current net decrease in current assets, add net increase in current liabilities, deduct net increase in current assets, deduct net decrease in current liabilities. That will give rise to your changes in working capital. Then cash generated from operation, that is the 3 plus 4 would be the cash generated from operation. Then taxes paid, that means the income tax paid on the amount of tax, whatever tax liability is there, and when that is being paid, that has to be taken into consideration here. The the resultant would be the net cash flow from the operating activities. This is the concise format of determining the operating activities of the cash. Operating flow of cash. Then the second item is cash flows from investing activities. That is purchase of assets or investments. Assets means the block capital or the assets like furniture, fixtures, land and building, plant and machinery, etc., etc. The investment means the bonds and shares. Then sale of assets and investments. The purchase of assets and investment will result into outflow. Sale of assets and investment will result into inflow. And interest on dividends received will result into inflow. And others, it may be inflow of cash or outflow of cash. And taking that into consideration, when there is net cash used in investing activities, that would be the 1 plus 2, the item number 1, plus item number 2, plus item number 3, plus item number 4. When all these are added together, that would be the net cash used in investing activities. That would be the flow of cash from investing activities. The next item is the financing activities, the flow of cash from financing activities. Financing activity means where from the funds are arranged for the organization for its very sustenance. Proceeds from issue of shares or debentures even. Then proceeds from borrowings. Borrowings may be either in form of debentures or it may be form of loans taken from banks. These two would be the inflows of cash from financing activities. Then repayment of borrowings, it will be the outflow of cash. Interest and dividend paid. Interest and dividend paid on shares and bonds issued by the company will result into outflow of cash. And when all these things are summed up, that will be the net cash flow from the financing activities. It may be a positive figure, it may be a negative figure. If the outflows are more than the inflows, it will give a negative figure. That will be the net outflow of cash from financing activities. In case it's a positive figure, it will be the net inflow of cash from the financing activities. Then all the inflows and outflows from all the three sources are taken into are to be considered, are to be summed up, and that will be the cash and cash equivalent from all the sources, all the sources are all the activities of the organization, and that has to be added with the opening balance of the cash at the beginning of the year. When that is added, if it is a positive flow of cash from all the three sources, that has to be added with the opening balance, and that will give rise to the closing cash and cash equivalent at the end of the year. The opening cash and cash balance must be available as the opening cash and bank balance in the balance sheet. That means the opening balance sheet, that means the balance sheet as on the beginning of the year must speak about the figure which is exactly there in the opening cash and cash equivalent as stated in the cash flow statement. When that got adjusted, when the opening cash and cash equivalent is added with the net inflow of cash from all the three activities during the year, or deducted from the net outflow of cash from all the three activities of the organization during that particular period, that will give rise to the cash or cash equivalent at the end of the year. And that cash and cash equivalent figure, as reflected in the cash flow statement, must tally with the figures given in the balance sheet at the end of the year. Suppose this is the profit and loss account of an organization. The organization is Kanishka Enterprise. And the profit and loss account shows, the trading and profit and loss account shows that there is a net profit of rupees 16,000. The different figures are: sales is 1,65,000, purchase is 80,000, direct expenses like wages, power, etc. is 20,000, and this gives rise to, or it resulted into the gross profit of 65,000. This gross profit of 65,000 is transferred to the profit and loss account. Then there is an indirect income of 13,000. And in the debit side of the profit and loss account, it is reflected that there is rent of 8,000, salary is 20,000, depreciation is 15,000, provision for bad and doubtful debts are 5,000, proposed dividend is 10,000, provision for taxes is 2,500, preliminary expenses written off are 1,500. Since all these items are expenses, they are debited to the profit and loss account. And as a result of this, the resultant of the profit and loss account gives rise to a net profit of 16,000. This net profit of 16,000 does not necessarily mean that the cash profit is also 16,000, because there are certain items here which doesn't result in, there are some items in the debit side of the profit and loss account which do not result into outflow of cash. Let us see in the next slide how the cash flow statement is being prepared from the operating activities. The net profit as exhibited in the profit and loss account is 16,000. Provision for non-cash transactions. Non-cash transactions, and that too expenses, means to that extent the cash is there in the hands of the organization without being put outside. That means those items ought to be added with the net profit to find out the cash from operation. See, provision for bad debts. Provision for bad debt is being treated as an expense and debited to profit and loss account, but it doesn't result into outflow of cash. That's why it is added with the net profit. Depreciation, exactly the nature is the same. It is being treated as an expense, but it doesn't result into outflow of cash. That's why it is added with the net profit to find out the cash from operation. Provision for taxes. Provision for taxes, it's a provision. It's not tax paid. So all provisions, they are debited to the profit and loss account with a corresponding credit to the provision account. So when that be the case, it doesn't result into outflow of cash. That's why it is added to the net profit to find out the net cash from operation. Preliminary expenses written off. It's not an expense incurred. It is the expense which is written off. Expenses incurred earlier, but now it is written off to that extent. So to that extent, there is no outflow of cash. So this 1,500, although it is being debited to the profit and loss account, it doesn't result into outflow of cash. That's why it is added to the net profit for determination of the cash from operation. So the total addition or the total item of non-cash transactions debited to the profit and loss account comes to 34,000. So that 34,000 is being added with 16,000 for determination of the cash from operation. There is another item in the credit side of the profit and loss account. You see, there is another item in the credit side of the profit and loss account, that is the profit on account of sale of machinery, and the amount is 13,000. So the profit on account of sale of machinery is coming under investing activities and it doesn't come under the operating activities. So that's why it has to be excluded from the cash from operation. That's why it is taken into consideration while preparing the cash flow statement or determining the cash from operation. So 16,000 is added with 34,000 and 13,000 being a cash, being an inflow of cash from investing activities. It is deducted from the net profit and the net cash from operation became 37,000 and that would be regarded as the operating flow of cash. Here, look how the cash flow statement is being prepared from the balance sheet. The balance sheet is, you see, when the balance sheet is given from which the cash flow statement has to be prepared, the balance sheet must be of consecutive 2 years. Here the figures have been given in respect of 31st March 2009 and 31st March 2008. The share capital is given, the share premium is given, the general reserve is given, the profit and loss account is given, the loans are given. And under the application of funds, different items are given like gross block. Gross block means it is fixed assets from which the accumulated depreciation has been deducted. The net block of fixed assets is given. Investments are given, net current assets are given, cash and bank balances are given, and the total of sources is 900. The figures are in millions. 900 as on 31st March 2009, and the totals of the assets and liabilities as on 31st March 2008 is 650. From that, when we are some additional informations are given, the other informations are during the year 2008-9 investments were sold at a profit of 25 million, and there has been no fresh investments in 2008-9. Then the second adjustment of the information says that interest paid and interest received during 2008-9 was 25 million and rupees 12 million respectively. During 2008-9, interim dividend of 20 million was paid. When taking the figures given in the balance sheet and taking the figures by way of additional information, when you prepare the cash flow statement, and the cash flow statement has to be prepared only on that 3 segregated activities like operating, investing, and financing, the cash flow statement would be like this. Cash flow from operating activities. First one is a change in profit and loss account, that is 25,000. You look to the profit and loss account. Sorry, the profit and loss account. It was 50,000 at the beginning, so 50 millions at the beginning and 75 millions at the beginning, means there is an increase in the profitability by 25 million. That's why it is taken as 25 here. Then our dividends paid as exhibited in the statements given, that is 20 millions, are transferred to reserve. If you look to the reserve, the general reserve, it was 150 at the beginning and 200 at the end. That means increase by 5. That means increase by 50 million, and that 50 million is taken into consideration. Our depreciation 75. You look to depreciation. Here the depreciation was 350 at the beginning of the year and 425 at the end of the year. That means increase by 75 millions. That's why the 75 figure is taken here. And here you look to the interest paid. Interest paid is 25,000 as given in the additional information. During the year 2008-9, investment were sold at a profit of 25 million. That's why it is considered here as 25 million. Then less interest received. Interest received is 10 million as given here. Interest paid and interest received during the year. Interest paid is 25 million and interest received is 10 million. That's why it is taken as here as 10 million. Then profit on sale of investment is directly given as additional information, that is 25 million. So that's why it is taken as minus 25 here. Operating profit. So operating profit is 160 and changes in the net current assets is 150. So the operating cash from operation became 10. So that is the flow of cash. That means a positive flow of cash. That means the inflow of cash from the operating activities. Accordingly, the flow of cash from investing activities are taken into consideration. Acquisition of fixed assets is 200. You look to this. Acquisition of fixed assets. Gross block was 700 at the beginning, 900 at the end, means 200. 200 is considered here. And acquisition of fixed assets means it resulted into outflow of cash. That's why the figure is shown with a negative figure. Sale proceeds of investment, that is 75. Sale proceeds of investment is given here. Sorry. Sale proceeds is given here, that is 75 million. That's why it is taken into consideration. Accordingly, the interest receipt as given in the additional information is taken into consideration. And as a result, the net flow of cash from investing activities became negative 115. Similarly, the cash from financing activities are also determined. It comes to 130 millions. So if we take into consideration from all the three sources, there is net cash flow is 25 millions, and at the beginning of the year, the balance of cash was 50 million, and when that is added with the net inflow of cash during the period, the net cash or cash equivalent at the end of the period comes to 75 millions, and that exactly tallies with that of the figure given in the cash and bank balance. So this is about the preparation of the cash flow statement from different items. That means the data must be given like income statement and the income statement, otherwise called the profitability statement, and the balance sheet also for 2 consecutive years. Basing on that, we can prepare the cash flow statement from different sources. Thanks to all.